All right, good afternoon, everyone. I am hoping that you are well. We are now pushing towards we are now pushing towards uh, the 26th of October for the exam date. So far communicated has been the 26th of October. So we are just about 4 weeks before that date. And I hope everyone is currently doing well and they are putting those hours into working through the needed knowledge to get to the level where they can be ready for exams. Today we are going to be covering capital allowances. Next week we are going to have, unfortunately, the last class on the 6th of October where we will cover capital gains. I'm hoping that because it's quite a big learning unit, I will see if we might have time just to do a quick glance at exam paper that we have on tutorial 201. But basically, we have almost done everything that we can. So I have tried to spend more time on each topic, on each learning unit. So the integration thereof, in terms of the exams, it's something that you can be able to quickly integrate and cover on your side. The important thing is learning the topics that and the principles that we have covered under each class. So that is the important thing for me. So quickly, what I'm going to do is I'm quickly going to share the objective of today's class. Uh, it is being able to distinguish between a repair of an improvement to a capital asset, distinguish between the different types of capital assets and the capital allowance applicable to them, calculating various capital allowances, calculate the scrapping allowance, the recoupment, and the deferral of a recoupment on the disposal of a capital asset, apply connected persons rules pertaining to depreciable assets and allowances. So that is what we are going to try to cover tonight. We are going to apply the exact questions that we have on the tutorial letter 103. So I'm quickly going to go through the capital allowances, and please try to integrate the capital allowances with your deductions, because you will find out some of the important thing you need to be able to distinguish between the two. So what is a capital allowance? A capital allowance is an allowance provided for tax purposes by the commissioner, which is South African Revenue Services. It is provided on a asset which you are holding for the main reason of producing an income. It's exactly like in accounting, where we use the depreciation and we depreciate an asset over its useful life. On the side of a capital allowance, we call it a write-off. We are writing off an asset as we are using it up until we cannot write off anything. So this is an allowance given by SARS as an incentive to actually reduce your income by applying the allowances, because SARS is of the opinion that if you purchase a machine, you should, to make income, you should at least receive an incentive thereof to be able to set off the revenue against the expenditure that you have incurred over a period of time. So when we are touching on movable assets, you'll find out that there will also be a binding general ruling, which we'll have to look at. So in terms of the Income Tax Act, most movable and immovable assets are covered. Those that are not covered are covered under binding general ruling. And this binding general ruling will always be provided to you. It provides the right of periods. So this is how far now we have came. We have done gross income in terms of the definition, specific inclusions. We have done deductions. We are now moving over to the deductions, which are capital allowances. So I'm not going to go through the background. It is something that you can be able to cover on your side. Right. I just wanted to quickly mute that person. Please remember everyone who joins, please remember to mute yourself. Remember to complete the attendance register. The attendance register has been shared. It is available for those that just came now. It is on the charts, on the meeting charts. If you scroll up, you will see an attendance register that you have to complete for today. So the first thing that we are looking at is repairs and maintenance. So repairs and maintenance is covered in terms of Section 11D, where specifically for a person to be allowed a deduction on repairs, one, there must be an expenditure incurred during the year. It must be on a repair of property occupied for the purposes of trade or in respect of which income is receivable, for the purpose of repairing machine and any other assets, for beetle treatment. So basically, those are the areas that one looks at before they understand if we are looking at a repair or an improvement. So, capital assets in their nature, in terms of the classification or valuation thereof, they include cost of improvements. So it's any major improvements that you are doing. So what becomes important now is to differentiate between the repair and the improvement. Remember, the repair, it's an expenditure which is allowed in terms of Section 11D, but the improvement will be added to an asset. Therefore, you will have to write off the improvement or depreciate it in terms of accounting over a period of time. Now, repairs, it's mainly restoring a damage to a capital asset. It's about restoration by renewal or replacement of a part of the whole capital asset. But in order to be able to repair, there must have been a damage or deterioration of the original asset, and the intention to restore must be able to be identifiable from the taxpayer. The part which is the repairing, whether it's by restoration of renewal or replacement, it must be distinguished from the renewal of the entire asset. So for instance, if in a plane you are fixing the seats and one seat is irreparable and you have to bring a new one, that replacement must be able to be identifiable on its own when you are looking at the entire asset. So a repair is different from an improvement. Why? Because an improvement, it's a creation of a better asset. It's when you are actually making a better asset, you are improving the original one that was there. So this has been, of course, taken through to the courts, where the concept of repair and improvement has been seen as vague. But the important thing for you to note is you must be able to pick up when a repair you can be able to claim in terms of Section 11 deductions, and an improvement which you can only claim in terms of the capital allowances. So, so you are given almost what this learning unit will focus on. I want you to remember this. We have discussed it before. Movable assets for small business corporation, we apply Section 12E. What does Section 12E says? It says, for manufacturing asset, we write them off 100% on the first year of bringing the asset into use. For non-manufacturing asset, they are written off over 3 years, 50%, 30%, and 20%. Manufacturing asset in terms of Section 12C, there is a write-off process for them. Non-manufacturing asset, a write-off process for them. So 12C, it's 40, 30, and 20. And then but we'll be able to cover this at a later stage. So it's 50, 30, and 20. And for non-manufacturing asset, it's over a 4-year write-off, which is 40% and 20% each year for the next 3 years. And the wear and tear allowance, it's a different allowance in the sense that this is the only allowance that you can portion over a period of time. So this works exactly like your depreciation works. The difference is you will be provided this period in the binding general ruling. And when you are provided this period, you apply it exactly like you would when you are calculating depreciation. So this is a tip. Immovable assets, Section 13, commercial buildings, residential units will just cover now. So Section 12C has already covered the write-off period that I have mentioned. And they have made examples, so we'll come back to it. 12E, 11E. The most important thing that I do want to say about 11E, and it's only, it's something that you can be able to see it when you are looking in your textbook. So in your textbook, specifically for 11E, it's 5.3.1. So this is also a part of the assignments which you had. And of course, I'm not at much liberty to talk about the assignment up until the 2-week period has been exhausted since submission. But there is a nice sentence that says, no wear and tear allowance is granted on an asset that is written off in terms of Section 12C. So this mainly means, I'm sure you can remember this question in your assignment. This mainly means if you had an asset initially, which you were applying Section 11E on, and now, or you were applying Section 12C, you cannot apply Section 11E on an asset which is written off in terms of 12C. So you proceed to only apply 12C. Remember 12C, it's not apportioned, so it's per annum. So it does not matter whether the asset is bought 1 day before the year end, you apportion 100%, as long as it's within that year. So the period, the apportionment does not apply on 12E and 12C, and only Section 11E is apportioned. Building allowances. So Section 13.1, you have an annual allowance of 5%. Commercial buildings, similar thing, you've got an allowance of 5%, except when the building was acquired without the taxpayer erecting or constructing it, then the cost must be adjusted as follows. And then you are given 55% and 30%. Residential units, urban developmental zone. This is a summary that's applicable. So I don't want to dwell much on the theory because I want us to do the questions and apply the theory. So disposal of an asset that was subject to an allowance. So this is section 11O, scrapping allowance. We'll come back to these things. I'll explain the recoupments, the deferral of recoupment. So I want us to try and do all these questions. Question 6.1 up until the last question, which I think is 6.4. We are going to, of course, learn all these principles that are covered in terms of your theory and the reasoning thereof. So let us see question 6.1. So I'm quickly going to open this. So here we have question 6.1. Sunshine Traders. Right, we're gonna read the required to find out exactly what we are required to do. So we are provided this information. We must now calculate the tax payable by Sunshine Traders for the year of assessment ended 29 February 2020. Right, so this is what we are required to do. Calculate tax payable. So we know that first we've got an income, and then eventually we'll have the deductions. So the information then is provided. We've got an income where we are provided that sales, cash and credit, it's 3,000. So we know that for gross income, it does not matter whether it's cash or it's credit, because credit, we're looking at accrual that it accrued to a taxpayer. So we will have sales. I just need to make this a bit bigger. Right. This is so that if we have to provide any reasons why we're not taking up something, we can be able to have the space to do so. Right. So we've got sales, we've got 3 million. Then we are told that there's an interest accrued in respect of credit sales to farmers. So it's an obvious thing. It's interest accrued farmers. And how much is it? It's 800,000. The next one, we are told that we've got proceeds from sale of patent for 150. And now we have to refer to note 1. So here is note 1. On 1 March 2018, Sunshine Traders CC acquired a patent at a cost of 120,000, which was used in the production of income. The expected useful life of the patent was 10 years. On 1 March 2018, on 29th February 2020, the patent was sold for 150. A taxable capital gain of 19,980 resulted from this transaction. So I want you to note that we must still account for capital gain before actually calculating tax payable. So this, we must just hold on it, because we are going to reapply this tax capital gain as we are moving along. So we've got a useful life of a patent was 10 years. So what do we do? Here it is, we've got proceeds. So what do we do on our side? So what are we looking for? So what must we look for in this case? Anyone? Do we actually say proceeds from sale of patent? Anyone? Anyone have a suggestion? What do we do? How do we deal with this question?
Are we not supposed to check for how many years have been used?
Why are we doing that? What do we want to check?
I'm not sure.
Aren't we
All right.
checking the cost of the unit? How much
Why?
value, taxable value we still have?
Why? Why are we doing that?
Hi.
I would say for wear and tear.
Yeah, we won't apply when tier here. It will be a capital allowance. But what I want to know is why? Why must we? What
We claim
figure?
we want to check the for the years that we have been using for it.
All right, no, that's fine. Let me answer this one. Please take a note of it because it's very important that you understand why you are doing something. So what happens here is we have sold a patent. What was this patent used for? This patent was used for the production of income. I want you to remember that. So which means when you bought it, SARS provided you a capital allowance because they were of the opinion that the reason why you bought this asset was for you to be able to produce income. So you were not buying the patent to actually resell it again. So what they did is annually, they gave you a capital allowance, which was reducing the tax that you were supposed to pay. Because remember, capital allowance is a deduction. So what SARS now needs to look at now is I need to recoup all the capital allowances that I provided to you. Because when I provided you the capital allowance, the intention of you buying the asset was for the production of income. So you were never buying it to, when you see that there is a demand for it, you resell it back to the market. So you were buying it mainly for production of income. So what then SARS does is to say, now we need to calculate recoupment because I need to recoup or recover all capital allowances previously claimed. So this is what SARS says. I need to recover all the capital allowances that were previously claimed. So just need to mute someone. So that's basically what SARS is saying. So please excuse that I will not have a neat answer sheet for you, but I just wanted to give you the context. So now what must we do now? So what we need to do now is to look what was the cost. What was the cost that was incurred for this asset. So as we can be able to calculate the recoupment. So we are told that Sunshine Traders acquired on 1 March a patent at a cost of 120,000. So that was the cost. Remember, we are doing for 29th February 2020, which would have started on 1 March 2019. So this was bought on a previous year, other than the year of assessment that we are working on. So this was cost 1 March 2018, and the cost was 120,000. So the next thing that we are looking at is what was the allowances, the capital allowances that were given, for this particular asset. So we first look at 2019 year of assessment, and then we'll look at 2020 year of assessment. So what is the capital allowance that we must apply? So I need you to page 13 and page 14. In terms of chapter 5, passing it. So specifically this part. So you are told here in this diagram on page 14, acquisition of patents, copyrights, and designs. So you are told here if expenditure is less than 5,000, the allowance will be a expenditure. But here you are told here, note that the allowance of 5% or 10% is deducted every year only in the first year until the full acquisition cost is claimed. So I'm going to look at the same description over the textbook. So the textbook says if the expenditure exceeds 5,000, the allowance is 5% per annum of the expenditure in the case of a patent, copyright, or similar property. It's 10% per annum in the case of a design or a similar property. So if the expenditure is less than 5,000, it is claimed in the same year. So let us go back. So in this case, the expenditure exceeds 5,000. That's the first thing that we look at. So we're saying expenditure exceeds 5,000. That's the first thing that we look at. Otherwise, if the expenditure was less than 5,000, we were going to claim the full 5,000 in the first year that the asset is brought into use. Second one, for patents, you claim 5% per annum, and only for designs that you can claim 10%. So it's patents and copyrights. So please take note of that summary. So in this case, this means the 120,000 would have claimed only 5,000 because it is a patent. So which means that in the first year, would have said 120,000 multiplied by 5%. What is that? What is the amount there? What is 120 multiplied by 5%?
It's 6,000.
1,000.
6,000. So this is what actually happened. So we'll come back to the 6,000 again in the current year, because remember, we have not yet given this deduction. This is just a calculation for now. So this means that as things stood, you had a tax value. In accounting, we call it a carrying amount. In tax, you had a tax value of 108,000 in your books. And you are told that you have made proceeds or sales. A sale amount need to mute that person. Right. So you had a sale amount of 150,000 as provided. Then the recoupment therefore becomes the difference between 150,000 and 108,000. I'm gonna just fix this now, which becomes 42,000. Now I want you to listen to this carefully. How much were the capital allowances that were previously claimed? Right. I hope someone was able to see this. The recoupment in terms of the calculation is 42,000, but recoupment is only limited to the 12,000 that was previously claimed. So, which means that your recoupment now becomes how much? It becomes only 12,000. So it's only limited to 12,000. So that's what becomes your recoupment. So all this was just an explanation for us to get to how much is SARS recovering in terms of the previously claimed allowances. So let us quickly move on. So this was the last income that we were given. So we move on and we go to deductions. Here it's called an expenditure. So I'll move on with the word deduction. So the first deduction that we have now to cover is the patent. And we have already calculated it. I'm sure everyone can see that we have already calculated it here above as 120 multiplied by 5%. Please note, the issue of knowing the section by head is not important. What is important is for you to know the exact percentage that you must apply. So we also have cost of sales. So under cost of sales, let's quickly see what note 2 says. Note 2 says, cost of sales comprise of the following. You've got stock on hand on 1 March of 700,000, which is opening stock. You've got purchases of 2,050,000. So remember, the opening stock becomes a deduction in your hands as 700,000. And your purchases becomes a deduction as well. So it's like you can quickly write off these things. Then you've got stock on hand on 29 February at cost is 750,000 and at market value is 775,000. So which one do we apply? Are we going to apply the cost or the market value? So remember, in terms of IS2, yes, someone can. So in terms of International Accounting Standard 2, inventory is measured at lower of cost or market value. So the 750 becomes income in our hands because we have not yet sold the stock. So then we've got bad debts of 100,000. It's a straight deduction. Then we've got doubtful debts, number 3. Can everyone still remember our doubtful debt for the previous year? We have to add it back. So for 2019, we have to add it back. It's how much? 84,980. The reason why I'm trying to be that fast is because I want us to learn all the allowances. So for 2021, let's quickly see what we are given. The list of doubtful debtors on 29 February amounted to 300,000. 100,000 are in arrears for more than 120 days, and 200,000 are in arrears for 60 days. The debtors balance was 750. 300,000 are in arrears for more than 120. 450,000 are in arrears for 60 days. So what do we do in this case? Remember, we always work with the list of doubtful debtors. So we never work with the debtors balance. We always work with the list of doubtful debtors. So we've got 100,000, which is more than 120 days. So which means that for 100,000 will apply. What is the percentage of the allowance for 100,000?
40%.
It becomes 40%. It becomes 40%, and for 200,000,
20. I think 25%.
I hope everyone is able to get all these things that we are mentioning. Please remember to mute yourself again after talking. 200,000 multiplied by 25%. Right. So that gives us 90,000, and everything is definitely negative. So that's the doubtful debt allowance. So what else is given on the balances? Salaries and wages. Note 4, salaries and wages. So what becomes important here is all these amounts are deductible, all of them. But now what's important is you need to write them separately. So it's salaries and wages, it's contribution to Provident Fund, it's annuity paid, so it's always important that you write them separately because they are taxed on a different tax section. So we've got 1 million, we've got 100,000 and 15,000, right? And we are told that we've got repairs of 50,000, note 5. The unpaved parking lot of approximately 40 vehicles washed away after a cloudburst. The parking lot was repaired and paved with bricks at a cost of 50,000. Is that the repairs or improvement?
Repairs.
All right, it's repairs because one, there was a damage, and then we have to replace the parking lot that was unpaved with paving. So it becomes repairs, straightforward, 50,000. Then we are told that the last item is depreciation. Right. Office equipment purchased on 1 September 2017 with a cost price of 125,000 and tax value of 25,000 on 1 March is still in use. So in this particular instance, we already know that now we need to apply section. Which section applies here? Which section applies? So we are informed that this company is a small business corporation. So section that applies on 6.1. What section?
Isn't it 12?
Is it 12C?
I know.
So for all your depreciation, you're gonna apply one section, which is called section 12E. Why are we applying section 12E? Because of one reason. The taxpayer is a small business corporation. So there is no other section that you apply if you are dealing with a small business corporation. You only apply section 12E. So what does section 12E says in terms of office equipment? So section 12E says non-manufacturing assets are depreciated over 3 years, 50%, 30%, and 20%. So in this particular instance, this asset was bought on the 1st of September 2017. So this simply means that you would have had 2018. What was the cost? 125. So you would have 125,000 multiplied by 50% in this year. And then you would have 2019, which would have been 125,000 multiplied by 30%. And then you would have 2020, which is the current year that we are in, which would be 125,000 multiplied by 20%. Can everyone see how does this section 12E works? So we're saying this is a non-manufacturing asset because it's a office equipment. We are already told. So this is what would have been charged in the first year, what would have been charged in the second year, in the third year, and this in the third year now applies to us, 125,000 multiplied by 20% gives you 25,000. And this 25,000 becomes a capital allowance for this year. So this is a capital allowance. Right, there's no need for me to calculate the rest of the other years, but this was just to show you how does 2020 feature into this asset. New manufacturing machine with a cost price of 330,000. So we're dealing here with a new manufacturing machine. So what is going to be applied here? This is bought. Yes, go for it.
I was going to say, since it's a new one, the first year will be 40%.
Is that what your section 12E says? Is that what your 12E says?
Oh, because it's a small business. Oh, okay.
Because it's a small business corporation. Remember I said only 12E applies, nothing else. for all your capital allowances. Office equipment will exactly do what we did. Sorry, it's office furniture. We'll do exactly what we did when we worked on the other one. So the asset was bought on 1 May 2017. So the year end would have been in 2018. And we are told that it was no longer suitable for business and it was therefore scrapped. So let's quickly look how we're going to get to the allowance for 100 for office furniture. So we're gonna have a similar thing because now we need to also calculate the difference is the amounts that are gonna change here. It was bought in 2017. So for 2020, we're gonna have 100,000 multiplied by 20%, which gives you 20,000. Let's make it negative. Right. Now, the next thing that now we need to calculate now is called scrapping allowance. So how do we calculate scrapping allowance? This is provided for you it's very nicely summarized as the last allowances that you are looking at in terms of how you calculate the scrapping allowance. So there is nice breakdown that is provided. So why are we calculating scrapping allowance? It's because we are told that this asset is no longer of value. So what must we do to calculate the scrapping allowance? We must take the original cost of 100,000 minus the capital allowances, which are also 100,000. So this is cost minus allowances gives you 100,000. But I think let's quickly go to the summary because I like it the way that it's provided. So we're gonna say cost, which is 100,000. So I just wanna come here so that we have more space. Then it's gonna be less 100,000, and then it gives you a tax value, and your tax value is going to be nil. The proceeds in this case is going to be nil. The tax value is going to be nil. The recoupment is going to be nil because this has no value. Therefore, if you are looking for any scrapping allowance, you've got nothing. So you will see as we do more questions where we might have scrapping allowance. So scrapping allowance in this case, it becomes a nil or a zero. I'm just putting a nil for you to be able to follow. And we are done here. Then we've got taxable income. So we take from sales, got 160, 980. Remember, I spoke about a taxable capital gain that I said from here now we will need to go and edit, and it is 9980. If you don't remember it, it's under cost and patent, taxable capital gain of 19,980. So we are asked to calculate tax payable. This becomes 180,960. So this is your taxable income, and this is your tax at. So please calculate for me how much will be the tax. Small business corporation rates. So how much will be the tax? Remember, the first 79,000 is not taxed. This is not above the, is it?
It's 7,137.
Right. Hope everyone got there. But how to get there is simple. We say 180,960 minus the first 79,000 that's not taxable, multiply by 7%, and that should give you 7,137, and this is tax payable that we are required to do. Right, let's look at question 6.2 quickly. Question 6.2, we are still dealing with a small business corporation as defined. Then in this case, we are asked to calculate taxable income of lazy HCC. So it's question 6.2. We are asked to calculate the taxable income, not the tax payable. So we're quickly going to have this, which represent the incomes that we need to quickly calculate. Then we're going to, right, then we're going to afford this a bigger space. So 6.2, let's quickly read the information. They are cosmetic product manufacturer, they are SPC. Sales, cash and credit, you just have to add them together and they give you sales. Cash and credit, 450,000 plus 5,025,000. So this is your income. This is your income. We've got purchases, cash and credit of 3,500,000 and so I'm reading the information provided. It does not seem sure. We can reflect on it. So we've got purchases of 357, 150. So purchases, it's a deduction. So which means that we will now have deductions. Purchases as given 3,587,150. We've got opening inventory 290,000. Then we've got closing. $330 becomes a positive. Then we have got bad debts. Then we've got doubtful debt allowance for the previous year. For 2019, it's given, so it becomes a positive 12,500. And then for 2020, we are given list of doubtful debts on 29 February, older than 60 days, but non older than 120 days. So it becomes 93,800 multiplied by 25%. 23,450, and that one becomes a deduction in the current year. Personnel costs, salaries and wages, contributions to pension funds. To pension funds, remember this one. It's just nice marks that are just given. 650,000 and 65,000. Then on 1 February, Lazy CC received a letter from Quick Attorneys regarding alleged facial damages caused by one of its night creams to the upper cheek of Emi Kumalo, a supermodel for Paris, Van Val. She's claiming 1.5 million, 1,500,000. The case went to court and the court ordered Lazy CC to pay Emi 1 million for her loss of income. So the question becomes, the 1 million, does it become deduction in our hands? So let's quickly look at this. Our year end is 29 February. We are ordered to pay for her lost income on 31 March 2020. So damages paid, not incurred in 2020 year of assessment. So we move on. We do nothing about it because it does not relate to this year. Legal expenses relating to the Emi Kumalo case. So legal costs, Emi case. What happens there? Is it deductible, non-deductible? Remember when the lawyers went to present at the court, they were defending a product, in this case, of the business. So it was in the production of income that we had to stand in for this case. So therefore the 6,000 becomes deductible because it's in there. It's closely connected to the production of income. So it's closely connected. So legal costs paid on behalf of Gen 11, we can already see that this is private cost. So this does not seem to be for the company. So it's private costs. And such private costs are prohibited that you can claim for on behalf of the company. We move on. Advertising, cost of advertising a vacant post in the Daily Informer. Remember, this is how we are looking for people if we are advertising. So advertising, on Daily Informer. This is in the production of income, so it's 3,750. Cost of erecting a billboard close to the local airport. Now remember, a billboard, it's a item that stands and does not move. So it's a billboard, it's just standing and it's not moving. Therefore, for us to create a billboard, we need to erect it so it becomes capital expenditure, because we will have a longer benefit on that billboard that we would have created. So advertising billboard, so it's capital in nature because we will have a longer benefit on it. So it's not deductible. So let us move on. Now, because now we have not allowed a deduction, we need now to look at whether the billboard can have what we call now a capital allowance. Because remember, if it's capital in nature, it's a capital asset. Now, which means we need to calculate now how much we can apply in terms of the capital allowance. So in terms of section 12E, remember we've erected it in the current year as far as the information is presented. So it's 28,850 and it's a non-manufacturing asset. So it's 50% in the first year that it is erected. So there's 25,850 multiplied by 50%, which gives you 12 million. This is 25, my bad. Lazy CC owned the following capital asset: a cosmetics manufacturing machine D, which was purchased on 31 January. Remember our year end, it's 29 February. Purchased on 31 January at a cost of 300,000, brought to use on the same date. So it's machine D. So it's 100% allowance given. So it becomes so we've got machine D on 300,000, second-hand delivery vehicle, which was purchased on 31 July at a total cost of 85,000 to deliver cosmetic products for Lazy HCC. So delivery vehicle therefore forms part of non-manufacturing asset. It was purchased in the 2019 year. So remember, we apply 50% in the first year, 30% in the second year, and 20% in the third year. So in essence, we're going to say 85,000 multiplied by 30% because this is now in the second year. A manufacturing building was erected on 30 June 2016 and brought to use on 31 August 2016 at a cost of 1,250,000. And this is where all the manufacturing for Lazy HCC is happening. So manufacturing building. So what is going to happen in this building is we're going to have an allowance of 5%. Remember, for buildings, it's immovable asset, it's not movable asset. So we're going to apply for 5%. So it becomes 125,000 multiplied by 5%, which is the annual allowance. Which gives you 62,500. Lazy HCC sold a technologically outdated machinery Z on 1 February 2020 for 20,000. It was originally bought second-hand on 30th April for 100,000 and brought to use on the same day. So what do we need to do here? We need to calculate recoupment. Remember, recoupment. That's what we need to calculate because now an asset was sold. So what do we do in this case? It's machinery, it's machine Z. So we've got costs. I want you to remember, we want to calculate recoupment. That's the main aim of doing everything. So cost we are given, it's 100,000. Capital allowances, for which years? It was purchased on 2016, so we are looking for 2017, 2018, and this was a manufacturing asset. So in 2017 already, this is when you depreciated, sorry, you wrote off this machine at 100,000. Why? Keyword, it's a manufacturing machine. So which means that your tax value was a nil. And your proceeds how much? 20,000. And therefore your recoupment is therefore 20,000. And the recoupment is normally limited. So it's normally limited to previously allowed. So what would have been previously allowed? 20,000. Therefore, your recoupment is 20,000. That's what your recoupment is, 20,000. Let's move on. The following costs were incurred relating to trademarks. Renewal fee paid. Remember, if it's a renewal, it's a deduction that you are getting for 8,500. Recoupment, it's a positive, so it's an income. New trademark purchased 55,000. So if you go over to that page that I referred you to, page 13 and 14 of tutorial letter 103, you will see that new trademark purchase is same as capital in nature, and there is no deduction that is allowed. So it specifically tells you on those page 13 and 14 that I provided you. Registration of a trademark. Registration becomes a deduction, straightforward, minus 78,000. It's a donation. So if you note, this number 16 was not applicable because of a type of a taxpayer that we are. So now we're going to treat number 15, which is a donation. So it comes after taxable income. So we need to take it up. So we've got taxable income of 605,725. So we've got a donation. So donation is limited to lesser of two options. %, of taxable income, which in this case, you can see how much is the actual donation. So it's limited to the lesser of 10% of taxable income, or you deduct the whole donation. So how much is the donation? We donated 15,000 to Ladies in Blue, a public benefit organization uplifting women in rural areas. And most important thing for you, before you look at donation, it must be in the current year of assessment, and there must be a Section 18A income tax receipt. So we've got both of them, and 10% of taxable income is, let's quickly see. So it's the lesser of these two. So what is the lesser? The lesser is therefore 15,000. Therefore, your taxable income is therefore 590, 725. So I hope everyone was able to follow through. So let us quickly look now at question 6.3. Question 6.3 is now looking more at immovable assets. So let us quickly look at question 6.3. What are we asked to do? Income tax liability. Right, let's work with what we have. We have to calculate income tax liability. The closed corporation has elected to claim Section 11O allowance in terms of the Income Tax Act and to make use of the building recoupment set-off. Right, let's see if we can quickly attempt this question. It carries on the business of manufacturing business instruments. So in this case, it is not regarded as a small business corporation. Before taking into account all of these, we had a taxable income of 5,800,000. So the rest now will be deductions. So we are looking at deductions. So fixed assets obtained in the prior years and still in use on 31 March. You've got vehicles purchased new on 1 June 2014 for 120,000. So we've got vehicles. So in terms of vehicles, we are going to apply section. What section are we going to be applying? So I'm just giving you this section, not for any other reason. Section 11E. Thank you. So what does section 11E entail? It says you have got to apportion, allowance, and we have to now look at where we can get information about binding general ruling. So we have got to read more information about it. Urban development zone will be fine, so we can do everything one by one. So here's binding general rule information. It gives you vehicles. It's 5 years. So we can immediately apply the 5 years. So if something was purchased on 1 June 2014, so we have got to calculate how long is it 1 June 2014. So to calculate an allowance, we have to look from 1 June 2014 to what period is it made. So it's 1 June 2014 up until 30 May 20. Is it 20 May 2020? 5 years. Why does it look like it's 2019? 30 May 2019.
It's 2019.
All right.
2019.
So 2019, this is equal to 5 years. So in this case, it means in the current year that we are in, we are only going to claim for 1 April 2019 to 30 May, or 31 May 2019, which is equal to 2 months. This is the only period that we can claim. So which means that vehicles of 120,000 is going to be divided by 5 years, multiplied by 2, divided by 12. By 2 12 gives you 4,000. So that's the capital allowance for the vehicles. Then the next one is
4,000.
it's a building. So it's building. Event development zone. Right. So for this building, we are told that the building purchased a new building completed by the developer on 1 November 2018 for 2,181,000. All the requirements to claim an urban development zone allowance were met. So what are the allowances that were supposed to be met? So I'm quickly going to read them for you. So these are the requirements that need to be met for the building or part of the building in respect of which the allowance is claimed must be owned by the taxpayer. The building must be used solely for the trade. It must be within an urban development zone. The erection of improvement must either be to the whole building or floor of at least 1,000 meters. The relevant details and certificates must accompany the tax return for the year. So where the developer incurred the cost, the allowance will be granted if the new building, the purchaser may only claim on 55% of purchase price. If it is a new building, if it is a second-hand building, may only claim 30%. So in this case, it is a new building. So this is a new building. So in this case, because it is a new building, it means sorry, quickly need to it's gonna be 2,181,819. First multiply by 55% because new, and then you multiply by 8%. This is urban development zone. This is the allowance. So which means that it's 2,181,819 multiplied by 55%, multiplied by 8%, which gives you 96,000. Right, let us move on. And fixed assets obtained during the year. 2 small items with a collective cost of 4,500 were purchased on 30 November 2019. These items qualify for Section 11E, wear and tear allowance. Now, Section 11E, 2 small assets. Section 11E says, if there will ever be a purchase less than 7,000 of small assets, that amount must be written off 100% in the same year that the expenditure is incurred. So this 4,500 is less than 7,000. Therefore, we are going to write off 100% of 4,500. Manufacturing machine was purchased second-hand on 1 June 2019 for 300,000 and brought into use the same date. So remember, machine we are going to apply section 12C, but we are going to apply the second-hand part. So what does the second-hand part say? The second-hand part says we have to write off 20% over 5 years. So you can also go back to your notes. So this means that we have to write off 300 multiplied by 20% or over 5 years. So this becomes 60%, 60,000. A new manufacturing machine new was purchased on 1 February 2020 for 450,000. So remember, it's just 2 months before year end, and it was brought into use on 1 March 2020. Remember, machine LL, it's also section 12C. It's now new, so we don't apportion. So it's going to be 450,000 multiplied by 40% in the first year, which is 180,000. Move on. Manufacturing building AA was sold, so manufacturing building AA was sold on 1 January 2019 for 5 million. Was sold on 1 January 2019 for 5 million, and Note CC had recoupment of 800,000, and it purchased a new manufacturing building ZZ for 9 million on 1 April 2019 and brought it into use at the same date. The cost was made up as follows: land 1 million, building 9 million, and the total was 10 million. So this becomes land. We first deal with the land. So in terms of the land, there is no allowance claimed on the land. Claimed on land, so it becomes a nil. So we deal now with the second part, which is the buildings. So buildings, the first thing, remember on the question we were told that we made use of building recoupment set off. What does this mean? It means that the recoupment which we initially had on the building that we sold will be used as a set off in the building that we are purchasing as a replacement, because that was not our intention in terms of this building. So in terms of manufacturing building AA, it was sold for 5 million. So in this case, we do nothing about this because we have deferred recoupment. So what we are looking at now, it is providing an allowance for manufacturing building ZZ. Remember here, we don't have to calculate recoupment because we have deferred recoupment in manufacturing building ZZ. Now, to calculate an allowance, we need to say cost, and the cost we are given is 9 million of this building, less equipment provided, which we have deferred. So now we are saying you can use this equipment to reduce the cost of the building. So the cost of the building therefore changes and it becomes 8,200,000, and from 8,200,000 you can apply the allowance of 5%, which now the allowance of 5% would be 8,200,000 multiplied by 5% gives you 410. And there you get your 410. So let us move on. Repair of an extension to an asset. The roof of a manufacturing building ZZ was badly damaged during a storm and needed to be replaced on 1 April 2019 at a cost of 220,000. Note CC decided to extend the roof to allow for an undercover parking for its employees. The cost of this extension amounted to 300,000. So straightforward, we can pick up that there is repairs of 220,000, and then we can pick up that there is improvements made of 300,000. So for your marks, please do not forget this. The extension on the roof, not deductible, because it's capital in nature. It's an improvement. Please don't forget this. This is marks. So you first test it as a deduction. So it's not deductible. So it's not deductible. Then the second part that we look at is then the allowance that you are going to provide on the extension. Now you've got a new asset called undercover parking. So the undercover parking costed you 300,000, and we see here binding general rule number 7 makes provision for the right of period of an undercover parking to be 5 years. So we're going to apply this 5 years. Because this happened straight at the beginning of the year on the 1st of April. Therefore, it's going to be covered in full, 300,000 divided by 5 years, which gives you 60,000 that you can claim in the current year. Assets that were sold in this year, we've got furniture costing 30,000. So we've got furniture. So in this case, it was sold to a pawn shop because it was damaged and was no longer usable. No transaction regarding this asset have been included in the taxable income. So which means you have now to look at two things. You have to look at your equipment and you have to look at your section 11O, which is the scrapping allowance because it was sold to a pawn shop. So let's quickly try and see if we can be able to get to this. So we initially had a cost of 30,000. We had allowances that were allowed in terms of binding general rule. On furniture, it was 6 years. This was purchased on 1 October 2018. So we need now to quickly calculate and convert everything. So 1 October up to March 2020. So we need to quickly calculate the period. So we'll first have allowance for 2019 year, or because it was purchased in October, so you will have 30,000 multiplied by 6, divided by 6, multiplied by 6, divided by 12 months. And then you will have 2020, which now in 2020 you had it for the full year, which you're gonna just say divided by 6. So this becomes 30,000 divided by 6 multiplied by 6 divided by 12. So we just say divided by 6. So your allowances therefore make up 7,500. Then your tax value becomes 30 minus 7,500, which is 22,500. Then you are told that this was sold for 10,000 proceeds. 10,000, which means that for this asset, the scrapping allowance is therefore $12,500. Therefore, we're gonna have here a scrapping allowance of 12,500. Remember, this 5,000 is in the current year, so we're gonna have in the current year an allowance of 5,000 as well on the same asset. So we move on. On 30 November 2019, manufacturing PP costing 290,000 was sold for 310,000. This machine was purchased new on 13 of June 2013. No transaction regarding this asset have been included in the taxable calculation, taxable income calculation. So now we have to calculate the recoupment. In this case, it was scrapping allowance because we have sold it to a pawn shop. In this case, because we have sold it normally, now we're going to look at recoupment. So we say cost. How much was the original cost? 290,000. So we apply allowances in terms of section 12C, because remember, this is a manufacturing asset. So in terms of 12C, what would have happened in terms of 12C? If it was purchased in 2013, you would have depreciated it over 3 years. So it would have been 50, 30, and 20. Am I doing something right here? Isn't it 40? Let me just quickly look at this allowance. Yeah, it is 50, 30, and 20. Not sure what disturbed me there. Right, so in this case, we would have written off this asset over 3 years, which is 2015, 16, and 17. So in this case, it's fully written off as 290,000 This is your tax value. Which is a nil. So we say proceeds of 310,000. And then we get recoupment. $310,000, and this recoupment is limited to previously claimed allowances. And what was the previously claimed allowances? 290,000. Therefore, we can now be able to calculate taxable income. Taxable income is therefore going to be sum. Just throw it to the beginning. And then there you have the taxable income of 5,030,000. Tax liability is going to be at 28%. So we are not informed about any provisional payments that were made. So we're just going to say 28%. And this becomes the amount that you have to pay. Any questions to everything that we have covered today? I'm not going to cover 6.4. You should be able to cover 6.4. In terms of everything that we have covered, there is nothing new. Any questions? The difference in 6.4 is an administrative building, which is a new part, and you just apply a 5% on administrative building. So that becomes almost it for today. So reflecting back to what we wanted to cover today, I'll quickly ask that you remember to complete the attendance register and also the evaluation form before you leave. So I've just shared those quickly, but just to remind you what was our goal today. Our goal was to make sure that you can distinguish between a repair and improvement, different types of capital allowances and capital assets, various capital allowances, Section 11O, recoupment, and when a recoupment is deferred, and that all we have managed to cover it. So please don't remember to complete the feedback form and the link to the attendance register. So what I will do now is I will remain for a few minutes just to take up the questions. Next class is next week. I'm also going to document this. It's next week, 6 October. And it's going to be from 1600. Please note that the next class is going to take 2 hours, 30 minutes. Thank you very much for attending today. As I said, I will remain for a few minutes to take up the questions that you may have. Thank you very much for today. Thank you. And enjoy the rest of your evening.